Who are you waving at?
Myself on the camera.
Okay, we are live. I don't see anybody on there. Melissa, are you on there?
I just got in.
Okay.
Melissa's in there now. You have to refresh or update.
Oh, update. There we are.
Now, once a real person jumps in, we have to either mute yourself if you want to say things.
Okay, I'm going to turn down the volume on Teams. So I can't hear you on Teams, so just chat. Raise your hand or text. Okay. How do I look? This is fun. Hello, hello, welcome. Let's see. I have some friends that jumped in. Jennifer, Marilyn, Bob, Leticia, and Joanne. Happy to see you guys here. Hopefully you got your lunch and you're ready to learn. Casey will be joining us in just a minute. If you'd like to chat with the group, please. Oh, thanks, Jennifer. Thank you. Please feel free to send a message, and yeah, we'll get started in 3 minutes. In case you want to go fill up your water bottle, make sure you stay hydrated. Let's see, Chris, I see you. Thank you so much for joining us. Happy that you're here. We're going to get started here in about 2 minutes. So if you have any questions or comments, feel free to add them to the chat section. I'll be fielding the chat questions as we go. So there's a way to reply to everybody or to just me and Casey directly. And if I'm not able to answer all your questions in the next hour, we'll make sure to get back to you when we're done. Casey will be joining us in about a couple minutes. Hello and welcome. I see a few others have joined us. Happy to have you here. We're going to get started in about a minute. Feel free to add comments in the chat section. I'll be fielding those throughout the presentation. And if you have any questions also and we're not able to get back to you during the presentation, we will circle back around afterwards. Okay, welcome. I see some more people have joined us. So happy you guys are here. I'm Niki Sullivan, and Casey's going to be joining us in a couple minutes. If you have, oh, there he is. If you have any questions, please feel free to add them to the chat. I'll be fielding the chat questions. And without further ado, it's 12 o'clock. So just like good mortgage lenders, we get started on time and we try to finish early. So I want to introduce my husband, Casey Sullivan, and he's going to take us through the forecasting of the mortgage trends for this year. Take it away, Casey.
Perfect. Well, let's get started. Let's jump to the next slide here. So we would love, after we kind of finish this, for you to fill out a quick survey. So we'll pop it onto the screen at the end, but we'll also send it out to you via email, just to get your input to see if these are valuable and if you like the online or if you like more in-person events. And a recording of this webinar will also be emailed out to you, so you don't have to take copious notes. You can always go back if you need to. The chat is definitely open. As Niki was saying, feel free to participate. She'll be mostly manning the chat if you have questions. And then any additional resources you can find on our Instagram page under the bio, the link tree. I feel like I've got a lot to cover in an hour, so I'm going to make sure that I get through this pretty fast. I want to first introduce the company I work for. I run a branch of CrossCountry Mortgage. If you didn't know, we are actually the #1 retail mortgage lender in America. #3 overall, if we take into account companies that do both, like regular mortgage lending and brokering or wholesale. They take loans from brokers. But if you look at just a mortgage lender that just deals directly with consumers, #1. Most people don't know that because we don't advertise on the Super Bowl and all that fun stuff. We're also the #1 non-QM lender. I run the Sullivan Group. My team, I'm one of the loan officers at branch manager. My wife, Niki, some of you know her. She's our business development leader. I've got Nicole Garcia. She runs our ops team. We've got Chris. He does our pre-approvals. He's our loan partner. We've got Melissa, who's been with us for maybe 8 or 9 years. She does all of our marketing. And then as any lender, we have all the other assistants and processors and underwriters, but those are our main team. We do lend in all 50 states. So if you have those clients that are talking about moving to, the most recent one we had was South Carolina, please feel free to introduce them to us. We're still happy to take care of them. And we do have 2 other loan officers in our branch, one of them focusing only on reverse mortgages. So if you ever run into any great team members in the mortgage business or great loan officers that could do well underneath us with our coaching, always feel free to introduce them to us as well. Let's see, let's go to the next slide. So kind of the main topics today is we're going to talk about mortgage market rates, a little bit about Fed, inflation, labor, the forecast. We're going to talk a little bit about real estate, mostly around demographics and cost of waiting. Then the hot topic of the day will be condos, balconies, and insurance for those of you that list or help people buy condos. And then we'll go a little bit over some products, depending upon how much time we have at the end, with a few being a portfolio loan, a fix and flip, and what I call a jumbo bank buster that we'll go over together here. Again, this is being recorded in case you need to go back to it, but kind of where are we with current rates? So this is from Mortgage News Daily, and this is looking back for 1 year. So you can see there's definitely been a range of kind of where rates have been. We did, as the Fed cut rates, last fall, we saw rates go down, but that was very short-lived, which none of us were happy about. So you saw that kind of August, September, early October dip in rates. On that chart, if you can see it well on your phone or on your computer, the yellow is jumbo, the blue is just a basic conforming conventional mortgage, and the green is FHA. And so that's kind of where we are now. If I look at Mortgage News Daily today, they're quoting 7.03%, which has been pretty basic and pretty stable for quite some time here. So that's kind of our current market that we've been sitting in. As we all know, if we go back to the last 3 years, this is where you see that buyer behavior of saying, oh gosh, rates went up, right? So if I look at January, February of 22, we were in the 3s. And then quickly moved up into the 5s and then the 6s and kind of where we are now. So that's the 3-year look. So those have been, for those of you that have been in the business for the last 3 years, you've been living through that as I have. Here's historic rates. I know we all talk about that with people and say, oh gosh, when I bought my first house, so I won't tell you my first house story, but it was definitely, high, right? And so this goes all the way back to 1980. And, we saw rates well above 15%. But you see that trend line that it's just been going down and down, and consumers that have only been in the home buying market for the last 10 years or so, they're used to seeing rates under 5%, which is sometimes why people think 5% is the right number to really open up the market. I see a lot of activity once we get to 6%, but 5% obviously is even better. So again, that's going back to 1980. When we look at like kind of what drives mortgage rates, you guys probably all know this to some degree. The main three things that we spend a lot of time looking at is inflation, labor, and what we call the spread. So as we've seen with inflation, it's felt like it's been a little sticky. So that's been a negative. Inflation was really high. It came down and it's just been kind of stuck. The last reading showed a little increase, but I wouldn't put too much into that just yet. We do have a positive coming, which is the relief of what we call the monthly replacement of shelter. So it looks at shelter, imagine rent, and if you look at the month over month or year over year, when we get the February reading, it's replacing last February's reading. So there is some positive numbers that should come out to help there. So we're hopeful of that. The Fed has been talking a lot about labor. So labor has been strong. However, if you've been kind of following the news over the last couple of months, they like to do revisions. So we're expecting some continued downward labor numbers and revisions. We've definitely seen a lot of stores over the holidays here closing. Then we have DOGE going through, and potentially that could be a negative if they're creating a lot of open jobs or unemployed people. And then you have the AI. A couple companies have said they've paused hiring in certain positions because they believe they can get some labor improvement using AI. And the last one we look at is spreads. We'll think of it as the appetite for mortgages. We'll go over where the actual spreads are now, but the spread, meaning the rate has to go up to get buyers to want to buy mortgage-backed securities. And if the spread or the interest rates are too high, if you're an investor in mortgages, you are going to expect that loan to disappear because the client is going to refinance it. So you end up wanting even a higher rate to do today's mortgage market rates. The 2025 forecast, there's a lot of people that are forecasting. We always start with the 10-year treasury, since that's what mortgages are going to be based upon as kind of the underlying kind of trend. So if we can get the 10-year treasury, as some people believe, down to 3.6 or less, now this could be an aggressive forecast. That's going to be a great move where we are now. Right now, we're about 4.55, so we've definitely come up. But if you look at that chart there, if you go back to August, September of last year, when the Fed made that first cut, it was right about 3.6. So that's what we're targeting back to. And it might take all of this year to get there, but hopefully we do get there. And then we're also expecting to see the spread between the 10-year treasury and the 30-year fixed to narrow a bit to also help with mortgage rates. So again, following the 10-year treasury is the number one thing we're tracking. And then if you do look at spreads, so the spread is going to be the difference between the 10-year treasury and the 30-year fixed rate mortgage. So if you look at this chart here, you'll see to the right, we're currently at 2.5% is the spread. Now in October of 2023, it pretty much hit a high of 3.1%. And then if you look at that chart all the way back to 2000, so back 25 years, you see that it likes to live in that range of kind of 1.5 to 1.8. So that's normally been the spread. Outside of the great financial recession in 2008, 9, and 10, you'll see that's off. But we haven't come back into that range yet. So as I believe the market starts to stabilize and we start to see kind of where this economy is going, we're hoping to see it drop back down. And if it does, that's where we'll see an improvement of mortgage rates without much activity. So if we play a little like what if game, let's say the 10-year treasury did hit 3.6%, as some people are predicting. And let's say the spread even narrows just 0.25% from 2.5 to 2.25. That gives us a 30-year fixed rate mortgage of 5.85. I love that number. It's well under 6%. We know that will get people off the fence or get additional sellers to want to list their house and move on to their next one. When we look at the overall outlook, I would expect like generally interest rates to be what we call range bound, meaning we're not going to expect a big break up or a big breakdown overnight, and kind of trending down below 6.5, maybe 6.25 by the end of the year. So as we know, that doesn't excite a whole bunch of buyers and sellers, but it does get us below the 7% we're at right now. There is some optimism in the financial services area about the halt on CFPB enforcement, rulemaking, and all that we're seeing there. So that'll be interesting to watch that play out. There's still some talk about taking Fannie Mae and Freddie Mac and making them private again, as they were before 2008, or at least having their interest rates follow the market a little bit better. So that could help us with some mortgage rates if they follow market-based pricing. Other outlook things is we're definitely expecting a demand for mortgages to continue to go up, which is where we'll see that spread go down. And the outlook with the Fed is they're basically on a pause. So we got some rate cuts, now they're on a pause. If you look at the betting market on the Fed, you're looking at, like, most people are predicting somewhere about 1 to 2 cuts for this year. But as you know, that can easily change. The real estate market. So that was mortgages. Real estate market. If you look at, the first-time home buyer, the young home buyer, I thought this chart was really interesting. I don't like it, but it is what it is. The yellow line is repeat home buyers. The black line is all home buyers, and the blue line is first-time home buyers. And what we saw is in first-time home buyers, the median age of a first-time home buyer in 1991 was 28. Now it's 38. And the repeat buyers in 1991, the average age was 42, and now it's 61. So we've seen a shift in who's buying and at what age. And let's see here. So the demographics. So this one, I'm gonna skip over, but what it's basically showing, this I feel like will take too much time on our webinar. I've shared it with other people, but it's basically showing that your millennial and your Gen Z, there's so much buying potential there that it feels like as inventory comes, like there will be buyers coming in to do that. It just comes down again to the inventory situation. So if you look at active listings, now this goes through, I think I pulled it through the end of 2024, maybe January 25. It shows you the average, like the active listing count in the United States. Now this is the United States, and we know that inventory can really change from market to market. If you were in parts of Texas like Austin or a lot of part of Florida in the South, there's a lot of inventory, so it doesn't perfectly match up because we don't have as much here. But if you look at the population from 2018 till today, it went up 12 million people, but the active inventory did not. So we need inventory, but we don't have it yet. If you look at salary required, for those of us in the San Francisco Bay Area, thought this was interesting. It looks at the 50 largest metro areas, and the most expensive is San Jose. And the salary required in order to buy a house in San Jose is $463,000. It's a pretty big number, right? If you look at San Francisco, it drops to $336,000, and San Diego, Los Angeles, and Seattle. So those are the most expensive. So sometimes we're meeting with people and they're just having an affordability issue, and this is some of the reasons of why you see that. Now these are metro areas, so San Francisco would include kind of the surrounding cities of San Francisco, same with San Jose. And then if you look at the most affordable, the least expensive, we've got Cleveland, Ohio coming in at number 50. Happens to be where CrossCountry Mortgage is headquartered, which I thought that was interesting. Median home price is $191, and your salary required in order to buy that house would be $58,000 a year. So you can just see how big of a shift that is between Cleveland, back to San Francisco or San Jose. Let's see, again, why we do loans in all 50 states, I guess. Now the cost of waiting, this comes up a lot. And it usually comes up when people are not sure if they want to buy, number one, or if they are also thinking a lot about interest rates. So it's about the timing of how a purchase today could affect the appreciation and monthly payment differences in the future. So what it really can show is the actual cost of not taking action. So the people that have just been waiting. Another way we can do cost of waiting is the old-fashioned like buy versus rent. And if you ever need a cost of waiting, I'm going to show you an example in a second. If you ever need these for a consumer, or you kind of want a couple different price points for people that you normally talk about, like we had an agent ask for one at 750, $1 million, and $1.5 million, I think it was. You just shoot me an email, tell me what you're thinking, and I'm happy to prepare the reports for you. The cost of waiting report looks something like this. It shows on this was a $1 million house. I used Contra Costa County, and it said if you wait 2 years, you basically are losing out on $97,000. So the benefit of buying now versus waiting 2 years is $97,000. It's a pretty good number based upon a $1 million house, right? Almost 10%. And it takes into account the appreciation. It also takes into account doing a refinance when we expect rates to be lower. So it's all factored in that, especially for people that say, I'm going to wait for rates to drop. So it shows that as well. It shows if you did wait for rates to drop, how would it work? And it just, unfortunately, it doesn't work in anybody's favor if there's appreciation. And for those, engineers that see it, you would get page 2, which shows you all the numbers so they can see how we came up with it. Moving on to condos. So this is a shift here. I'm making sure we don't have any crazy questions I need to deal with. Nope, we look good on questions. Again, if you have any, feel free to pop in. So we went over kind of where mortgage rates are. We know they're sticky. We believe trending down, but not super fast. In the real estate market, we obviously need more listings, especially in the Bay Area. And we're seeing some shifting in how the buyer, like when the buyers are buying, and the affordability issues, what we went over. So now let's talk about condos. So always happy to chat more about this offline, but I believe from the lending side, what the buyer protocol would be is you would have a lender check each condo before you make an offer for a buyer. So reach out to, if they're not using us, reach out to them and say, here's the address or the name of the condo that we're considering. Can you look it up? You could also go to the lender and say, hey, they're looking in this city or this area. Are there any condos you can tell me to avoid? Just so you guys don't spend too much time on a condo that you already know could have an issue. For a seller, if you're helping a seller, I would always ask the seller about any notices they've received. It's funny, sometimes, at least my experience when I talk to listing agents, is the seller pretends like they didn't get anything. But some of them are upfront and they can tell you, oh yeah, there's this issue, they're doing these repairs, they're not going to be done for a year, or whatever the case would be. But see if they have anything, because the HOA does send out notices. At minimum, have your lender or me look at the condo you're preparing for market, so we can let you know if we see anything out there on the condo. The optimal is you would have your lender pre-approve the condo itself. And it would allow you to market the condo as pre-approved. So it's similar to think about pre-approving a buyer. We pre-approve the condo. We look through all the condo docs before you have any buyer on it. We do our full review. We get what we need, and we can actually issue an approval for it that you can include even in private remarks on NMLS. The additional information about condos is there's condo lists. So in the past, people would always ask me if a condo was FHA approved. Good question. So there's a FHA list, there's a VA list. There is now a very well put together conventional, or what we call a Fannie Mae list. For condo products, they don't really have a list anymore. What they do is they tend to piggyback on Fannie's list. And then the kind of bonus list is some lenders like us have an internal list. So if I did a condo recently, it would be on that list internally, or if one of my colleagues in the Bay Area did a loan for somebody in a condo, I could kind of piggyback on the documents that they had pulled together. Now, if a condo is not on one of these lists, basically a lender would need a full HOA package. And the main things we're focusing on, I mean, we'll look at all of it, but the main things that really stand out is the three things. Number one is the HOA master insurance. So here we're looking to make sure there's full replacement coverage and the deductible is within guidelines. If you're aware of the Rossmore community in Walnut Creek, that's a great example of not having full replacement coverage and not being able to qualify for FHA or conventional financing. HOA budgets we look at. The main thing we look at there, it used to be we look at the reserve study a bit more. Now we focus more on the budget. And Fannie Mae wants us to make sure that there's 10% of the HOA dues that come in each month or each year going towards reserves. So it's just like, are they budgeting enough to go to reserves? And the lender questionnaire, this is a special form that lenders request. Usually the HOAs are used to filling out this form, or they already have it pre-filled out. And the main things that come up are things around litigation, sometimes special assessments, and inspections. So let's talk more about kind of the inspection side of things. So, there was this Surfside collapse in Florida in 2021. There was 98 people that passed away, in that collapse. And Fannie Mae basically has triggered the request to ask for inspections on the condo for the last 3 years. So that was their response to that. Because if you look at as they investigated that collapse of the condo, they found out the HOA had all these inspections around the structure of it that they did not address. So they figured if they look at the inspection reports as part of the condo review, they would have caught it. Not that the HOA would have fixed it, but at least it would have set up a red flag. Then there was a Berkeley, a dorm on UC campus. I don't know if it was owned by the UC, that collapsed in 2015. There was 6 deaths and 7 critical injuries. And that triggered the state to require balcony and what's called elevated walkway inspections every 9 years. And the first inspection was last year. So all HOAs, and the law is SB 326, had to go through and inspect all their elevated walkways and their balconies, and then obviously address any of the critical items. And this will happen every 9 years. So we're going through a cycle right now. Then there'll be 8 years where we're not really worried because the inspections were already done and the repairs were made, and it will come back in again 9 years. It's like the locusts, right? They come back every certain number of years. So be ready, set a timer, set a reminder for 9 years from now. If critical repairs are needed on a condo, based upon the inspection reports, it must be done before the loan closes. If not, then the term in mortgage lending is non-warrantable. That means you cannot basically get a mortgage. A non-warrantable loan, are available. We do them in-house, and this type of a loan, the main things that we're finding as we've been dealing with balcony issues is the main questions that I have to address is, number one, was a contractor hired? Number two, is there a timeline available for the repairs to be completed? And how is the HOA going to pay for it? Are they going to take out a loan? Are they going to do a special assessment? Do they already have the reserves and they have the money to pay for it? So those are the main things we're looking at. And as a lender, since this is non-warrantable, it's a portfolio loan. So the thought is do they have an exit plan? Or are they going to be stuck in this world of balcony issues and then start getting fines and getting red tags and things like that? So those are the 3 things. We did look at a condo last month, and the HOA basically said they had not hired a contractor, but they were planning to. They had no timeline and they had no money to pay for it. So they were considering a special assessment. So in that case, it was more going to need to fall under true hard money loans or a cash buyer. But as soon as they can get the contractor hired, the timeline put together, and have a plan to pay for it, then they should at least be eligible for the non-warrantable loan. Let's see, do I have any questions on this? I do.
Mike has a question.
Mighty says, for condo inspection, are HOAs required to share inspections with the lender if it shows up? Yes. So on this lender questionnaire here at the bottom of the screen, it is, we either have a Fannie Mae form that they can use, or a lot of times they use a system called HomeWise to pull their HOA docs for us, and they usually have a lender questionnaire in there. Now with that one, it will say there was an addendum added a few years ago, and it says, have there been any, do you have any inspection reports over the last 3 years? And it's a yes, no. If yes, then it asks for those reports. So for example, if they did the SB 326 last year and they're going to say yes, we're going to ask for that balcony report. We're going to look at it. If it was clean, all good, right? No issues. If it shows that there were some critical repair items on there that need to be addressed, that's when the next level of questions will come, which is this work done? Is it in process? Will it be done by close of escrow? And that's where that question goes in. So we don't start off by saying, give us all your inspections. Like, that's not a normal request to the HOA. Usually it's they fill out the lender questionnaire, and then depending upon how they answer that question, it asks for them. So if you know already that there are some inspections, it's good if you can get any information out of the property manager as to was there anything critical that needs to be addressed now, and if so, what's the plan? Is this scheduled? Is it a timeline, or are we still trying to figure that out?
Okay, I think we're good with questions. We can move on. Thanks, Maichi. Good question.
Condos. So again, condos, if you've got a buyer that is looking at condos, like, make sure you really connect up with their lender and make sure that they're really looking into it, and they can look into each one that you make an offer on, or they can proactively look in the market and say, hey, these 5 are blacklisted by Fannie Mae. So we have access to that list of both the approved Fannie Mae condos and the blacklisted Fannie Mae condos. A lot of condos, when we look it up, could also fall in the middle, which is nothing. Fannie Mae shows the condo, but they don't show anything about it. So with those, that's where we have to go through the documentation. The very best situation is when somebody's using a conventional loan and it's already approved by Fannie Mae. We're good, right? We don't have to go through all the questionnaires. I don't have to ask about inspection reports. All we basically have to do is get an appraisal, if the program requires it, and get the master insurance policy to make sure they're still properly covered. So some products, we're going to go over a little bit about the lowest rate program, some first-time home buyer stuff, some investor, some BBYS, which is buy before you sell, and portfolio and jumbo. I'm at the halfway mark of this, so hopefully you're still engaged here and you're still able to see everything here on the screen. So the lowest rate options that we see in the market right now is FHA, VA, and jumbo. FHA and VA are a little bit more obvious because they have some government backing. But jumbo, it will change from kind of investor to investor. So you may go to one lender and their jumbo rates are higher. Mortgage News Daily does their daily rate index, and they show jumbo rates are always higher. Our jumbo rates for people with good credit and whatnot, they are lower than a conventional mortgage. So we just have an outlet for that. It's our own product. So we are finding jumbo is cheaper. So we do appreciate that in our higher cost areas. Other cost savers for consumers that are concerned is we have a program called Bye Bye PMI, and that's if you've got 15% down, there's no PMI. We basically cover it for them. So it helps people that are concerned about, well, I don't have 20%, but I don't want to pay PMI, so I'm going to save more money. We can at least get them to 15% and not have that PMI. We still do our free refinance. We were just quoting somebody today who bought about a year ago. So we will do it again. We won't charge you our lender fees again. And there's some first-time home buying programs too that can help with the costs, and that's what we're going to talk about next. So for first-time home buyer programs, there's, if you think about from like loan program wise, there's the conventional mortgage is your basic Fannie Mae mortgage. The requirement is 3% down. There is a feature in there if they have the right income, if they're in the right income band for the county they're buying. It's called an LLPA waiver, and what that basically does is it removes any of the add-ons or the risk factors that Fannie Mae would normally charge on a mortgage. So if their credit's not perfect, or they're buying a condo, or anything that would increase the points or the interest rate on it, it will waive those. So that's been very helpful for a lot of our buyers. FHA, that program does go up to 100%. We have a program where it does the normal 3.5% down for FHA, and then there's a second mortgage that can come in and cover the rest and make it 100%. So all the buyer has to do is pay the closing costs or get a credit from the seller. There still are your DPA programs, your down payment assistance programs. I generally feel that they are marketed a lot on the internet, and the marketing is way better than the program ever is. That's generally how I see it to be. But we still get a million calls asking about what programs are available. The two top ones in California is the CalHFA and the GSFA. So both of those have some different programs that help with down payment, help with closing costs. Some is a loan, some can be a grant. There are other programs that are set up and they're grant programs. Some of these depend upon the county in which you're buying, sometimes it's the county in which you're living in now that you're going to move out of. So these are grant programs. Usually you'll see, if you take any listings, sometimes you'll get some lenders out of Southern California that will send you like, hey, this program or this property qualifies for $7,500 first-time home buyer grant. So there are programs out there like that we offer. There are programs for professions and occupations. So this is where, do you have a doctor loan? Yesterday, I had an educator who asked if we have an education loan. So those programs are out there. Again, they're kind of like the down payment assistance programs generally, as they look really good on a flyer, but they're not always that great in the background. And a lot of say doctors end up not using the doctor program because they can get better terms maybe on a traditional jumbo loan.
Hey, Case, Maichi has another question.
So Maichi has a question about a credit to help cover buyer's PMI. At the 15% down on that program, we don't even give a credit. We just cover it on our side. Otherwise, a credit, so PMI is normally charged as a separate line item on a mortgage statement. It's called borrower paid PMI, right? So it shows up on the mortgage. Then there's also an upfront PMI. So the buyer, or they could get a credit, could like buy out the PMI as an upfront. So we can run kind of both options there. And so that's where we've done a credit on the mortgage itself to buy out the PMI. If somebody doesn't qualify for that 15% down, or let's say they want to do 10% down. So there are some options there. What we always want to be careful of is we don't want to create too much of a credit to pay for the PMI too far in advance if we think we're going to refinance the loan in the next couple of years. So I always run that math just to make sure that we're not throwing money towards PMI for 10 years of buyouts when that loan will probably be refied. But yes, there are some options there. One of our favorites that we like is called Home Run, and this is no PMI at all if it's within a census tract. Or the new version of it also says if you're within an income range. So because it was census tract based, it's hard to quote somebody when they're out shopping for a home. But once they find a home, we always are checking this program. Some clients really like it and they want to, so I give them the map of where it does qualify for them, so they know where to buy. But this is, again, no PMI. So imagine you have buying a condo. This is a loan we did, a condo. It was a 630 credit score and they want a 3% down. Normally that would be a pretty high interest rate because of the down payment and the credit score and a condo, and they would have PMI. This program kind of waives all that. So it's quite a great path for people that are either in that right census tract or in the right income level. If you have a listing and you ever feel like you want to check it, you can always send me the address, and then we can prepare a flyer so that when you're holding the house open, you can say this house qualifies for this program. Again, that's called Home Run. When it comes to investors, we have a loan. I call it the investor cash flow. It's traditionally called a DSCR loan, which is debt service coverage ratio. So think of your investors that are out there buying. All we're doing is using the subject properties rental income for loan qualification. So we're looking at the housing payment, which lenders call PITI. So we're looking at the total housing cost versus the rental income. And it doesn't always have to be positive, but interest rates are better the more positive it is. And when we look at rental income, we're going to look either at if it's already rented and that renter will stay there, we do have to look at that. But otherwise, the appraiser, when they go out to appraise the property, will come up with a rent survey to let us know what the fair market rent is for that property. So the borrower's employment and income is not verified or documented. So we're not looking at their W-2s and their pay stubs and calculating a debt to income. We're not looking at that. This is purely the property itself, hence the name kind of investor cash flow. When we've done commercial loans in the past, this is how a commercial loan is generally done. We're not really looking at the person buying a commercial building, their income and assets and debt to income. We're looking more at, hey, does that apartment building does that, office building does it, cash flow, is it a good investment? With this investor cash flow, you could technically do 15% down. Most of our buyers do 20 to 25% just because of the better terms. You can be down to 620 for a credit score. So it's not a very particular program when it comes to qualifying. One of the features some of our investors love about it is you can actually buy the house in an LLC. So if you think about a conventional traditional mortgage, say Fannie Mae, they do not allow you to buy the house in the LLC. Now, some people may put it into the LLC later, with their attorney's advice, reviewing the mortgage documents and things, but you can't go directly into the LLC. So this allows them to create the LLC, put it into that LLC, and never have their individual names part of it. It does also work for short-term rentals. Think Airbnb. There's this service called AirDNA that will give us what kind of the normal occupancy is, for the market. So if you're looking at Tahoe, like how many days is it normally rented for? What's the average rent for that type of a product? And that helps us determine what the short-term income will be on it, because the short-term income will be very different than if you rent it out for a year. And this program also fills a need where somebody can own more than 10 finance properties, which is where conventional mortgages cut off. So you can have 20, 50, 100 different properties. So that's big for investors. Again, investor cash flow. Fix and flip is another one that we run into with investors. So, for the best case scenario, especially somebody who's done this before, they can come in with 10% down, and then we can fund also 100% of the rehab costs. So this is generally for people that are, buying it to fix it and sell it. At the end of the fix, they could truly choose not to flip it, and they could just refinance it into a traditional mortgage, either that investor cash flow loan or a traditional conventional mortgage if they wanted to keep it as a rental property. So when you have people who are finding properties that need some work, especially if you don't think it would pass any of the kind of conventional appraisal, condition requirements, this is where the fix and flip comes in. It does do better for people who have done these projects before. If it's a first-time buyer who's never done a flip, the down payment is, I believe, most of the programs are around 20%. Let's see. Now, this is a popular one. Gosh, spent a lot of time on this, buy before you sell. There are so many different ways to do this. I think the simplest way that we talk about this with consumers is we can do a HELOC on their current property or add a fixed rate second. And that, I typed that in there, it says play ahead, but that means plan ahead. So, this is where people are coming to me earlier in the process and saying, okay, here's what we want to do. And I say, okay, let's get a HELOC in place so you have the money, because we don't want to have a contingency for them to obtain the HELOC in order to buy the house. We want it to be contingent free. So if we can get the fixed rate second or the HELOC ahead of time, that's great. Something that's a little bit more moderately complex is what we call a bridge on the departing. So this is where we're putting a quick mortgage against their house they're going to leave. So it's similar to the HELOC or the fixed rate second, but you don't have to plan ahead. We can do it at the same time as purchasing the property. And all it's doing is pulling money out of that property. We also have a very interesting portfolio product, and its main claim to fame is if somebody doesn't qualify to own two homes at the same time, it allows us to exclude the payments on the house they're going to sell. So we can exclude property, the PITI, the whole thing. They can even go get a HELOC and bring in another mortgage payment, and we can exclude that as well if they need to pull some equity out of the property. So again, with that program, it's allowing us to not have to hit them with the payment on the departing. And then the more complex one, but it's kind of also easy, so it's interesting, but it's complex, is there's some that are guaranteed purchases. You might know them as like HomeLight or Fly Homes. I don't find a huge fit in the Bay Area for these. But the one we do quite often, I think we have 2 or 3 active transactions right now. I call it the Golden Bridge. It's also called a cross bridge or a cross collateralized bridge. What it does is it looks up the combined value of all properties that you're putting up as collateral. So imagine your departing house and the new house. And as long as you're at 75% combined loan to value, you can basically pay cash for the house or get 100% financing on it. The two transactions that I can think of right now, because they're more recent, both of them have enough equity in their departing house that we're able to do 100% financing on the new property. And then what it does is it gives them 11 months to move into the new house, move out of the old house, prep it, get it all staged, get it ready to sell, and then sell it. Most of our clients seem to pay it off in about 2 to 3 months, but it does give you 11 months in case you needed extra time. And you're only paying interest for the amount of time that's on there. So the Golden Bridge is by far kind of the solution for some people, especially works for the larger home prices. The other common one is that portfolio loan. Then if we look at portfolio in general, some lenders call it non-QM. I don't like that because what does that mean? You know, and does that even matter? It doesn't, but just think of it as not going to Fannie Mae. So with this, we've got a very strong program in-house, which most lenders don't have it because remember we're the #1 non-QM lender right now. So we underwrite the loans and we look at exceptions. I think last year, I think it was 35% of our non-QM loans, our portfolio loans, all got funded with an exception, at least one exception. So meaning, you know, the guideline is this, but we went in and said, well, we've got this situation, and they expanded the guideline to fit the loan, 35% of them. So if you look at self-employed people who maybe their taxes don't support the income that we're looking to need for the purchase, we can do bank statements. Usually it's for 12 months. So we look at all the deposits for 12 months. We apply an expense factor based upon the type of business, how many employees they might have to determine their income. There's also a profit and loss version of this where we don't look at bank statements or taxes. We just look at an audited profit and loss statement. For independent contractors, you know, we can look, you know, kind of like 1099s is basically what we're looking at. So we're going to look at the 1099s versus looking at the actual tax returns. This tends to work really well with like the tech people who maybe were W-2 and the employer flipped them to 1099s, or they just do consulting for a lot of different companies. Then there's the creative people. So this could be designers. You have some insurance agents who get 1099s from a lot of different insurance companies that they might broker the products to. And then realtors are on 1099s. So with this, we take the 1099 income and we take an expense factor, and that is the documentation for income. This program also does allow for the ITIN. So this is somebody who does not have a Social Security number. Generally, this is somebody who doesn't have legal papers to have the Social Security number, I guess that would be, and work here, but they have filed taxes. So that's where the ITIN loans come in. We've got one that works for assets. So imagine if you have a client that has a lot of money, but not a lot of income. So the asset-based loan will allow us to underwrite based upon the assets. So imagine you have a client that wants $1 million loan and they've got, you know, $1 million in the bank after they put their down payment. So they have enough money in the bank to pay off their mortgage. We're good because they have what's needed to pay it off. Nikki, I see you joined our webinar. Do we have questions?
Yeah, there's a question from JP and from Jody.
JP, can a HELOC also be done on a rental property to take money out? Yes, we do investment property HELOCs. You're right, a lot of lenders will not touch investment property HELOCs, but we definitely do have that program. So yes, we both have a HELOC and we have what some people call a HELoan, which is like your fixed rate second against the house. So yes, that can work. Jody asked, regarding the buy before you sell loan option, can this be done with a VA seller if they want to use their VA loan for their replacement property? Unfortunately, no, because to use your VA eligibility, it's rare to have enough eligibility to have two houses on the books at the same time. So when you have a VA loan, you have to have your other one closed in order to free up the eligibility. The VA calls it eligibility, in order to buy the next one. Again, you'd have to be buying really, really cheap homes in order to have enough eligibility to do it at the same time like that. So generally the answer is no. Unfortunately, we've tried to find solutions to that one, and that's a hard one. At that point, if somebody was thinking that, we've looked at kind of the cross-collateralized bridge loan to let them do the transaction and then sell their house, which would clear up the VA eligibility, and then do a refinance. So the cross-collateralized one could technically work, but I find that usually when somebody has a VA loan and they want to use VA again, they tend to not have that huge equity base. So that has stopped us many times over. So again, assets, we have a client right now who wants to buy a property, and she has a trust, and it's a pretty hefty trust. She does not have a job at all. And so her husband has a 1099 job, which isn't going to be enough to buy their house in Marin. So their assets are being used in order to underwrite the loan. So that's for your asset heavy people. That could be people that have, had an IPO, worked at a company. The portfolio loan we already talked about does those non-warrantable condos. So again, we'll look at them, kind of common sense, and we're mostly concerned about, is there a timeline? Do you have a contractor, and do you have the money to pay for it or a plan to pay for it? The non-warrantable condos can also work for other issues that condos may have. Right now we're stuck on the balcony just because that's something that's current, but in the past, we've had issues with litigation or other factors. Or condotels. So we did a loan in Hawaii that was a condotel. We thought it was a condo. The consumer thought it was a condo until we figured out that there's actually a rental desk at the front and you can rent it out. So that turns into a condotel. And this program is what we use for the condotel. Got about 15 minutes. I'm right on track, a little ahead of schedule. So this will be perfect. Jumbo. So with Jumbo, we have an internal Jumbo loan. I call it the bank buster. When I see clients who go out to the big banks that tend to have pretty good Jumbo rates, they might not have the best speed or process. It might be a little bit like DMV at the banks, but they might have a great rate. This Jumbo loan that we offer is usually the same or a little bit better than the banks. So internally, I'm calling it the bank buster. And it's got great rates. It's got great speed because we're doing it. It also is we're very responsive on it, and the program moves fast. We get to use my appraisal panel. We don't have to use what a bank may use, pick amongst 1,000 different appraisers. We can underwrite it up front and get you an underwritten pre-approval. It does something called AUS. So that's automated underwriting system is what lenders would call AUS. I call it Jumbo Ease. So meaning the old Jumbo or the original Jumbo is where you have to look through all the manual guidelines. It's a person actually going through everything. There's very little automation. Whereas on an FHA loan, a VA loan, or a conventional loan, we run it through the system. Sometimes people call it DU or desktop underwriting. That's the Fannie Mae brand of it. And it runs through and it makes a lending decision. So on our Jumbo loan, we run it through AUS and we get an approval that way. And it ends up taking out a lot of those random conditions that Jumbo loans sometimes have that consumers get frustrated with. And it does work for lower loan amounts. So as long as it's greater than $806,500 in the Bay Area, it can go on Jumbo, even though that doesn't technically need to be a Jumbo loan. But a lot of times we get a better rate by doing it that way. So if you have clients who, I'm pre-approved with my bank, like, oh my gosh, like you at least have them talk to me and let's just do a quick comparison on rates. Because I think you'll find a lot of times we could be pretty competitive on that and you'll get a better speed. And then if you guys want more from us, so we love to do networking happy hours. If you haven't been invited to those, you will be since you got invited to this. And what we do, it is local to the Walnut Creek area for those of you in our marketplace here. And we pull together local professionals. So we want you and us to meet different people. So we bring in real estate agents, we bring in financial planners, CPAs, attorneys, like divorce attorneys, trust attorneys, some insurance people, all together so that we're not only talking real estate, we're also just talking professional networking. So we do those usually quarterly, and you're always welcome to come to that. It changes from time to time who comes. Sometimes we're more financial planner heavy, sometimes there's more attorneys, but come out, meet some people, you might build some connections there. When it comes to education, I love educating. So we always have, we have things coming up. We have an ongoing buyer webinar. So if you have open house leads or online leads and you want to ever invite them to learn about the home buying process, it's very easy. It's a the same software as you're using here to watch me. They would just sign up. It will ask them how they heard about it. So if they put in your name, I'll make sure to let you know that those people did join in, and they can learn in 30 minutes. We do it 3 times a month. One day we do it in the middle of the day, like I think on a Tuesday. And then we do an evening during the week, and then we do a Saturday. So to kind of catch wherever buyers might have free time, right? If they have soccer on Saturdays, that's fine. They can do it on Wednesday night or Tuesday in the lunchtime. So please, utilize that. If you need a link to that or a flyer, just shoot us a message for the buyer webinar. We also find that we have some realtors who have some success at open houses by kind of publicizing that versus trying to kind of get on the more realtor sales side, where maybe some consumers are a little standoffish because they think you're going to maybe make them sign something, but you can kind of push this educational tool that we've done for you. And it's not branded with any realtor or anything. So, you can say my lender does this for my clients. Realtor webinars, which is what you're on right now. Great. We will hopefully continue to do these. Other times we do in-person lunch and learns. And then weekly communication. I hope you're all getting what I call the deal, which is in the Friday email. It kind of gives a program or something that's coming up. It gives you a quick little chart of where the interest rates are. And then I also do a market update voicemail every Thursday. If you're not getting that, shoot me a message. I'm happy to add you to that as well. I believe Niki was going to pop in the poll or the survey in case you wanted to do that while you're here on the call. Otherwise, you will get an email with the survey. We, again, would love your feedback. This is a new way that we're trying to do some education is on webinars, so you guys can multitask or be driving and still listen in. So we'd love some of your feedback.
Yeah,
12:52, 8 minutes short. Perfect.
That's right. We always want to close early, don't we, Casey?
Oh, it's always good.
Yeah. Thank you so much to everybody for spending your lunch hour with us. We sure hope that this was value added to you. We will be doing more of these in the future. We love to educate you. We think it's important that you have the tools that you need to be able to help those buyers and sellers in this difficult market to be able to accomplish their dreams. So if you want an individual appointment with us, if you want to come visit us at our office and learn more about what we do, we would love to have you. But we just want to say thank you from the bottom of our hearts for trusting us with your clients and for trusting us to give you some information today. So thank you so much for filling out the survey, and we hope everybody has a wonderful Wednesday afternoon. Thank you for coming.